already. The biggest problem with reducing prices, trying to solve the COVID problem, is that then becomes your normal selling price. Simply put, if I bought a pair of socks from a shop and then they had a special, they sold it for me at 10 bucks and the market price is like 40 bucks. And then I tell my neighbor and my friend that, hey, there's a special. Do you realize that when they go into the shop, the expectation is that they get in the product at that very same price? And for a business, it's a catch-22. You need to find that sweet area. I'm not saying do not have specials, but what I'm trying to say is that do not let your specials become your normal prices. Okay. Number 3, gross margins are too low to cover your overheads. That's when now, this is where we call it ninja pricing, where your cost, it costs you 20 bucks, but you're trying to sell your products at 22 bucks. So your margins are so thin that should anything go wrong, should you have one product break, it has killed your GP margins. That's not a good thing to do. Always give yourself enough GP margins so that in business, there's going to be eventualities and events that you really cannot control. In the middle of a production, there could be load shedding. Now you have to get a generator. You have to work overtime. All of those incremental costs, make sure they're factored into your pricing, okay? Clients who pay too slow. Now, this is another one that came out in the questions quite often. How do I make sure my clients pay on time, Peter? So here, again, I have 3 principles because of time, right? The first one, put contracts. Second one, contract, what do I mean? Your clients need to know there's a particular selling date, and if they haven't paid by then, you can either enforce it legally, you can call a norma guys, all right? Or you can pretty much start charging penalties and interest. Or lastly, you can actually have early settlement discounts, where you're saying if you pay within 10, 20 days, hey, I can give you this discount. But again, that discount can now eat into your GP margins. Think about it carefully, okay? And then from there, to move right along. Brilliant, okay? Do you have the ability to drive positive cash flows from the operation? Keep in mind, we've just defined what cash flow is. So that means if I find myself as a business owner, I have bought stock in cash from my supplier. It's sitting in the warehouse. No customer has bought it. I'm sitting with a net outflow. I have paid. I haven't received money. Or scenario 2, I've sold the stock, but I haven't collected from my clients. Again, same issue. Still sitting with a negative outflow. But what do I do as an owner to make sure that my cash flows stay correct? Okay. And then from there, one of the other things I want us to touch on. Now, we'll try by all means, we'll talk to the organizers of the event and make some of this information available either on our social networks, social media networks, websites, however. But some of these points, you would need to then sit down, look at your business, and really think about this webinar again, okay? Here, when we're now looking at does your budget and forecast plan for what you want to happen talk to reality? One of the things I've seen, I'm yet to see a business that has forecast that says they'll make a loss, you know? And the reality of it is because as business owners, we don't really apply our mind when we're setting budgets. The problem with that is that we can't even track. We don't know when we're on track, off track, completely lost, or you're tracking budget. That should say, when you're then budgeting as a form to enhance your cash flow, let your budgets talk to your cash flows. For example, if you know very well none of your customers have paid within 30 days, why would you go budget that you'll get the money in 30 days? Okay. And how you deal with it, consistent improvements to your business, particularly the cash flow, will enhance your sustainability and success as a business. Okay. So here are my basic steps for running a successful business. Now they are mine. Not saying you should now use them, don't use them, it's your choice. They're mine, right? First, keep a financial score. I'm one person at any given point in time, I can tell you to the cent how much I have in the account, what am I expecting, which client owes me, because I keep a score. Okay. It's not about the money, but someone has to keep score. Set goals, short-term, medium-term, long-term. Okay. Use high-impact marketing. Make sure you're in your client's face. They know when they need the product. At the time you want them to buy, they might not necessarily be there to buy, but what you need to constantly do with your clients is make sure that what do? You are there. You are available when they need to buy. At the time they need to buy, you need to be the first person that comes to mind, right? You need to monitor trends, find best practice, motivate your staff, because ultimately they're the ones dealing with your client. And number 10, one of my favorite, take a break, rest, Wafetu, rest, okay? And then now into another topic that has come up quite often is, what is the difference between accounting and finance? Now, to simply put it, I always say that accounting is a language and finance is the reality of it. Meaning accounting is a financial language of recording, preparing, analyzing, and presenting stuff. Whereas finance is the basics and the fundamentals of how I run a business. In the very, very wise words of Warren Buffett, he says, accounting is the language of business. If you can't speak the language, you're going to find it difficult to play in the game. Simply put, what that means, you're going to now start applying to banks. Banks, I need a loan. Banks, I need funding. Investor, I need you to pump money into my business. Now, the investor, the bank, they're going to say, give us certain documents. Now, those documents are not just for them to go file. That documents need to tell a story. And that story is what we call the financial language. Okay. Already getting some shout outs out here. Thank you so much. Thank you so much, guys. This language moves to showing your business activities, how they are translating into reports. Meaning when I look at a set of financial statements, I need to be able, without talking to the business owner, understand what happened. That's why the income statement is called the statement of financial performance. How did you perform? How did you do over the year? And later on, when we're touching on the ratios, you'll see how that kind of fits in. I need to be able to see how much cash did you have at a particular point in time. And then the second part, now looking at, or the third part rather, looking at the financial statements, there are certain things that I still see business owners get wrong. The first thing is the balance sheet, right? The balance sheet tells simply the health of the business, okay? That's comprising of my assets, current, fixed, non-current, current. That's just accounting language, but it gives you a financial health check, right? And then my liabilities, meaning I go borrow money to buy assets so I can generate profit. Simply put. Now, if I don't go borrow money, I'll talk to my shareholders right above there. Shareholders, can you pump in money? I go buy the assets, I make profit. Or turnover rather, okay? Simple, very, very, very simple, right? But how do you make sure you increase your assets without the corresponding increase in liabilities? This is where now the beauty of the performance, okay? The income statement tells you the performance over a period of time. When I used to do accounting 1 at the good university on Empire Road there by UJ, they used to say that the balance sheet, it's a snapshot, boom. It's at a point in time, your financial health. You were healthy today, you're no longer healthy tomorrow. The income statement is a video. It shows you the performance over a period of 12 months. How did I perform over a period of a specific period? That can also be in the form of what they call management accounts, okay? Now, when we start looking at the financial performance, that's when I start looking at how much did I sell, my revenues right at the top. That will give me my gross profit. Sorry for the overwriting script. Then my EBIT, EBITDA. Now, if you want to sound fancy, this is now a quick tip, right? Next time you're applying for a bond or you're applying for a loan, rather anything for your business, one of the key words to throw around is your EBIT, EBITDA. You know, it makes you look smart, but reality of it is that it's what the company is making after it has taken into account certain expenses that it can't run away from. For example, you are in the designing space. Someone wants a garment for Durban, July. There is no way you can do a garment without buying material, unless if you plan on stealing it, and that's a different story altogether, you know? So included in your EBITDA would be that, okay, I'm gonna price this person 50,000, take 20,000 to go buy the material. Once I bought the material, there's someone that needs to and work through it. That person needs to be paid. Similarly, those would be your other costs. So here, to move from revenue, we less cost of sales, which is cost of what it makes me to buy the material, and then I get my gross profit. Then any other costs that are involved in selling that item, my social media, data I'm using, delivery of transporting the goods, marketing, sales, commission of the guys trying to sell the stuff. I'll then get to my EBIT or EBITDA, excluding depreciation and whatnot. Now, for those people that want to be fancy, you can have EBITDA and then start adjusting for COVID. But that's now, if we're being too technical, there I'll have to charge if you want to consult, you know. And then we'd get finally to our net profit. Our net profit then would be what we make after all of these things. Okay, so that is statement number 2. So we've covered statement number 1, balance sheet, statement number 2, income statement, and we're going to cover statement number 3, which is my cash flow, right? So questions, guys, I'll take them right at the end just to make sure we cover everything. So cash flow, again, as we've already said, it's managing my cash inflows and cash outflows, okay? And then cash from investing and cash from financing. Did I go borrow money? Okay, cool. And from here, these are some of the things that we'll find out that on the right is those things that slow your cash going out, tips to kind of slow it. So pay more on credit, take time to pay your debt, your payables, reduce having a large amount of income, okay, reduce your equipment needs, and get creative, not illegally, guys, but get creative in how you manage your relationship with your suppliers. For example, whichever supplier I start new business with, I hope none of them are in this call, my general rule will be that, no, at the company I work, the policies we pay after 45 days. Right? But to my customer, the company policies you pay within 30 days. Do you realize that what I'm trying to do, I'm already managing the expectation that my supplier expects payment 45 days and longer, and my customer ensures that they pay within 30 days. Meaning I need to have shorter payments. I'm trying to accelerate the cash coming in. I need to have more disciplined in collecting, follow up. And guys, there's nothing wrong with following up with your customers when they've paid. Chances are, it's true, they are also doing the same thing with their customers. Call 5 times a day if you have to. Call 6 times a day if you have to. But get your money as soon as possible. One of the other things, give incentives for early payments, give penalties for late payments, increase deposits. Hey, dude, give us a 30%, give us a 50%, give us a 70%. I've come across a lady I did work with a couple of years ago. She needed a 90% discount. I'm like, that's everything, chief, you know? and that was what, have various ways of payments, e-commerce, credit cards. Hey, some people have been taking Bitcoins, you know? But do what you gotta do to make sure the cash comes into the business quite fast, right? And why is costing? So now moving right along, guys. So we've covered the financial statements. Now I want to cover the costing side of it. Because a lot of things that I see with a lot of my customers is that they would say, I tendered, or a client came for a quotation. I gave them a code, they paid, I delivered the work, but I made a loss. And I'm like, you didn't know. What drives your selling price? What drives your cost? So you need to know each and every element that goes into your cost. For example, simple one. I'm an influencer. Someone comes to me and says, Peter, I need you to advertise my products online. And when I'm now advertising my product, in my costing, I need to cost the time, the data, the depreciation on my phone, the opportunity cost as well. And then we'll touch a bit when we're talking about costs, okay? Costs are a very important driver because unless you are considerate of your costs and you build them to your client, then you're in the wrong webinar because we'll have another one for NGOs. You're running an NPO, non-profit company. If you're running a profit company, you need to have a thorough understanding of all of your costs and be able to mark them up properly, okay? So you need to have a full cycle of it. So now a lot of these stuff, guys, I'm going to run quite quickly. So you see, we have different types of costs. They have what we call direct costs. Those are the ones you can't run away from. Overheads, your electricity, your water, your opportunity costs, very, very important. If you are not servicing that client, would you be doing something else that's making you money? If the answer is yes, there's an opportunity cost. Even if you're chilling at home, you'll be watching TV, that has a cost to it, okay? Operating cost, and lastly, government cost, fixed cost. And I guess if you're in the tender space, there'll be other costs that, you know, for all intents and purposes, they'll call it contract cost, okay? And then from there, we then have your generic cost of sales, or what would be your direct cost. That would be your opening stock, less whatever you purchased this year, minus plus whatever you purchased this year, minus whatever is sitting in stock at the end of the year. That will be what determines your cost of sales. Now, the reason I'm trying to go into this detail is that when you then have sent stuff to your accountant, hopefully it's us. If it's not us, it's still okay. And they send you back financials and you're going through it. You need to ask certain questions. You need to probe, okay? Find out from your accountant, okay? My cost of sales, can we look at it? It looks too high. What did you include in there? My OPEX, what's sitting in there? Sometimes it makes you look smart, but over and above, it is a thorough understanding you need to understand. Okay. Then the other costs that we don't see often, but this is where your accountant now would have to give you advice. Your standard costs, meaning if you're in the production of garments, if you're in the production of something that you do in volumes but in repetition, what you would then do, you'd have a standard cost. So for example, people that are producing phones, I'm going to show my ugliest phone. Because it's a routine process, they almost know how much it costs to do one phone. Now, the moment it deviates, as a business owner, you're going to know something went wrong in my production. So that'll be a standard cost. Then you have incremental costs, sunk costs, relevant costs, joint costs, discretionary costs. Those are the things that, difference between us and you need to consult us for them. But overall, these are also costs that are embedded in the process just to improve your efficiencies as a business. Cool, guys. In the last few minutes now, I'm trying to run through then financial analysis. One of the key concepts as well that I see a lot of business owners struggling with is determining how many units do I need to make a month to break even. Now, last year, if you go on our website, there was an SME we started doing work with. He's in the pizza industry, right? Meaning he was just producing pizza. He loved what he did. But the first question I got when I asked him was that, dude, how many pizzas do you need to sell a month to be okay? He didn't know. So you're just selling, you're just producing, But then the moment you are able to determine your break even, you're able to know what can you tolerate, what can you tolerate, what do you need to push your sales team, what do you need to push yourself in business development. Break even, although it's an important concept, it's relevant for short-term planning, because it just tells you when I'm not making a profit and I'm not making a loss, what is my safety net? Okay, so it looks at the relationship between cost, revenue, output levels, and profit. Okay, we're running now, guys. And then, so we're going to take a simple example for break even. Okay, there are two ways of calculating. The first one, it says how many units do I need to sell. The second one, it says how much do I need to make? And then from there, you'll be able to know, should I be able to accept a special order or not? Meaning, if I can break even, I've covered my basic costs. So whatever I make over and above that I can be able to play around with my pricing. Okay, so we're going to take a very, very simple one. So the formula is there. This is how it looks graphically. It has to look smart as well, guys. Come on now, get value for money. So this is how it would look graphically. So this is where your total revenue and your total cost would intersect, and I would start making profit. The rate is where you are and you don't want to be. And you'll see here, there's an FC for your fixed costs. So your fixed costs are embedded in your break-even calculation. So we're going to take a very simple calculation. So my selling price is 50 Rand. Okay, my variable cost is 40 bucks. My fixed cost is 70,000. My budgeted sales is 7,500. What is my break even? I'm going to give you 2 seconds. 1, 2, boom. Okay. Then from there, this is how I'd have to do it. So I need to sell 7,000 units to break even. And this is how I determine to it. Meaning if I'm targeting 7.5 units that month, I have what we call a margin of safety of 500 units. Now you can convert that and do it inversely as a profit calculation. Okay, so we're approaching the end, and this is where my best part kind of comes in. This is where now we start looking at the financial health check. You as a company, you as a business owner, you need to be able to tell certain indicators. Similarly to when you cough, these are symptoms of what? Of flu or COVID these days. Or when you are blushing, these are symptoms of you might be in love, So as a business, there's going to be symptoms your business shows you. You need to know what those symptoms kind of convey. So the first one is what I call the liquidity ratios. Very, very important with liquidity ratios. It shows me my ability to pay my short-term debts and liabilities, okay? Then the second one is your solvency ratio. That will be on a more longer period. Can I still survive? Am I solvent? And my profitability ratios. Now, again, for those people that are scholars that might want to really, shine and take the moment, there is a whole range of other ratios. Return on assets, return on equity, bloody this, bloody this, bloody this, bloody that. But for this, all intents and purposes, these ones are the critical ones, and I'll tell you why. First and foremost, liquidity. It measures the short-term ability of an enterprise, right, to pay its obligations as they mature. Meaning, month end, will you be able to pay your rent? That's a liquidity issue. If you can't, you've got a liquidity issue. Okay. Now, these are some of the formulas of how it's calculated. Boom, 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 boom. Who does it matter for? The short-term creditors, such as the banks and your suppliers, they look at this ratio. So if you're now going to your suppliers and you're looking for facilities, they will look at your liquidity ratios. That means how fast you move your stock, how quick you collect from your customers, how long you take to pay your suppliers. They will look at all of that. Okay, that's in your liquidity. Then you start looking at your solvency, is the ability of the company to survive over a very long period of time. Okay, but who cares? Again, it's your creditors and shareholders. It's different here. The shareholders are now involved because as a shareholder of the business, and now, again, I guess in this webinar, we might have those people that are actively involved, but as a shareholder of the business, this is where you now start concerning yourself with, is this business really worth staying in, or should I be selling it? Should I now be looking at getting partners, getting new products? It's more a long-term view, right? And then your profitability ratios will start looking around, what is the gap of how did I perform during the year? You see here, we have what we call a return on asset, your GP margins, profit margins. Now, all of these formulas, we're probably going to treat them sometime during the day. So follow us on our pages, get on our social medias, either Lenoma or us, you know, you eventually will get the information. And who cares about profitability? It's everyone, because people want to know that you have the ability to grow, you have the ability to raise capital, you have the ability to be liquid. Meaning, if you're a company and you're trying to get funding today, tomorrow, or anywhere in the next 10 years, you're looking to stay alive, you're looking to really impress your shareholders or whoever you report to, profitability ratios are critical. They are the life of a business. Okay. And in closing, guys, I'm wrapping up. Every business owner, you should know your financial statements. That goes without saying. The same way you know the product, know your numbers. That's a language. Okay. Understand your cash flows. Difference between cash and cash flow. Okay. Know that profit is an opinion. Very, very important. And cash flow is a fact. Profit, you can come to me. We do accounting, there's depreciation, there's all these nice things we bring in. It's an opinion. Cash flow is a fact. You can't change it. You can't move it. Okay. And then last but not least, the importance of budgets. Okay. How do we link budgets? Budgets is no longer just that thing you do because someone said they need projections, but link that to your strategy. It needs to talk to that. Where you're trying to go as a company. And then lastly, your costs. Understand how your costs behave in COVID and out of COVID. And then again, I guess now I can open the floor to questions. Maybe I see.
All right. We actually got a couple of questions.
Yeah.
So I'm going to start with the first one. The very first one, that is from Koli. And Koli asked, is it healthy for a business to take a loan at this stage, especially looking at the economy?
Again, I'm going to play it safe. Yes and no. And I'll tell you why. If every business owner is confident of their business, they think they're not going to fail. Even those people that the bank repossesses cars, in their hearts, they're still sure I'm going to pay this car. But the reality of it is that you need to have what we call a risk appetite. Yes, the interest rates are low. If you guys got the appetite as a business to take interest, you can take it provided you can grow the business. But if you're taking it to survive, I wouldn't give that advice. But again, it differs. At this stage of the economy, you need to be very, very wary. Because let me give you a simple example. You take a loan, you go buy two new trucks for a fleeting company. We're going back into lockdown level 5. How are you going to pay it 2 months later? You know, so you need to be very, very, very careful about that. Thank you so much, Toby. Thank you so much, Toli, for the question.
Okay, then there's a second one, and wait, did I miss it? Yes, Tabiseng asks, how do you measure or determine whether your business is liquid or not?
All right, very, very simple. I mean, on the slides, we do put the calculation, but simply put, for your liquidity, you're going to look at 3 things: my current debtors and my current payables. So the people that currently owe me for the service that I've given them, and the people that I owe for the service they've given me. Who exceeds who? Is it a 2-to-1? Is it a 1-to-1? Is it a 3-to-1? Now, there's no set fast rule of that. It differs from industry to industry. For example, I'm in the services industry, so I wouldn't have a lot of stock. So when I'm looking at my liquidity, I'm looking at clients that owe me, that I've done work for, and clients I need to pay. because they've done work for me. Okay, but if you now have elements of inventory, you will need to then take that into account into your liquidity. So this will be then straight cut. But then generally, as I said, on the slides we're going to post or on the pictures we're going to post, you will then have a detailed calculation. Or simply put, go into the internet and Google liquidity ratios formulas. And then actually there are sites that you can just slot in the numbers and it will calculate it for you. Thank you so much. Oh my God.
All right. So, ladies and gentlemen, there are some more questions that are going to come through. And thank you so much, Peter. Thank you to everyone that also shared their insights and shared their questions. I did say that we only have 1 hour to our disposal. So we're going to try and move as swiftly as possible to our second speaker, which I'm very excited about. Peter, go away. It's not your time now. So, Ms. Leah Lakedi, I'm going to invite her to the floor now. And Ms. Leah, very excited about. She is the co-founder of Lenoma Legal. And I'm so excited to be dealing with the legal aspects of everything today. So I'm not going to take up much of her time. I just want to check. Leah, are we good? Are you fine? Can we
Yes, we're good.
jump on now? All right. Peter, I think you're